Hi friends, today we are going to see about
Introduction to financial markets. Business firms need large funds to undertake the desired project. Accumulation of these funds may be beyond their capacity in a responsible period of time. Government need funds to provide goods and services to the people. Financial market facilitates the needs to funds by issuing and selling different instruments. Financial market also helps to investors to facilitate them to invest surplus funds and earn a return. With the help of financial market, all kinds of business, government and financial institutions can get financial assistance in terms of both short-term finance and long-term finance. Before going into the details, let us have an understanding of the Indian financial system. The Indian financial system can be broadly classified into the organized sector, consists of regulators, financial institutions, financial markets, and financial services. The unorganized sector consists of the money lenders, individuals, bankers, etc. The financial system facilitates the flow of funds from the suppliers to the users. The following are the meanings and definitions of the financial market. A market wherein financial instruments such as financial claims, assets, securities are traded is known as financial market. In other words, financial markets may be channels through which flow loanable funds directed by the suppliers who has an excess of assets towards a demander who experiences a deficit of funds. According to Brigham Young F., the place where people and organizations wanting to borrow money are brought together with those have surplus funds in a financial market. A financial market, unlike the market, is more of an intangible concept, and the sellers usually participate in an exchange of assets such as equities, bonds, derivatives, and currencies. Financial market is a market creation and changes of financial assets from the household savers to business firms or financial institutions as in the following. A financial market is an institution or the arrangement that facilitates the exchange of financial instruments such as the equity share, preference share, debentures, deposits and loans, corporate stocks and bonds, government bonds, and more exotic instruments such as option and futures contracts.
financial market transaction
May be placed either at a specific place or location, example stock exchange, or through other mechanisms such as a telephone, telex, or other electronic media. Scope of Indian financial market. The financial market provides financial assistance to individuals, agriculture sectors, industrial sectors, service sectors, financial institutions like banks, insurance sectors, provident funds, and the government as a whole. With the help of financial market, all above the stated individuals, institutions, and the government can get their required funds in time. Through the financial market, the institution get the short-term as well as long-term financial assistance. It leads to the overall economic development. Types of financial market. Financial markets can be classified in the different ways. They are as follows. On the basis of type of financial claim, debt market and equity market. Now we can see debt market. Debt market is the financial market for trading in the debt instrument. Example, government bonds or securities, corporate debentures or bonds. Now we can see about equity market. Equity market is a financial market for trading in the equity shares of companies. On the basis of maturity of the financial claims, money market and capital market are the maturities of the basis. Money market is the market for short-term financial claim, usually 1 year or less. Example, treasury bills, commercial paper or certificates of deposit. Capital market is for long-term financial claim, more than a year. Example, shares and debentures. On the basis of time of issue of a financial claim. Primary market is used to include all the institutions that are involved in the sale of securities for the first time by the issuers. Here the money from the investors goes directly to the issuers. Secondary market is a market for securities that are already issued. Stock exchange is an important institution in the secondary market on the basis of timing of a delivery of a financial claim. Cash spot market is a market where the delivery of the financial instruments and the payment of cash occurs immediately. Example, settlement is completed immediately. Forward or future market is a market where the delivery of assets and payment of the cash takes place at predetermined time frame in future. On the basis of organizational structure and the financial market. Exchange trade market is a centralized organization stock exchange with standardized producers. Over-the-counter market is a decentralized market outside the stock exchange with a customized procedures. The above classification is not rigid, or one market may become under the more than a category. Now we can see the role of financial markets.
One of the important
requisites for the accelerated development of an economy is the existence of a dynamic and resilient financial market. The financial market is of a great use for its country as its the economy is following manner. Saving mobilization. Obtaining funds from the savers and the suppliers or the surplus units such as households, individual business firms, public sector units, government is an important role played by the financial markets. Investment. Financial market plays a key role in arranging the investments of a funds thus collected in those units which are needed of the same. National growth. Financial markets contribute to the national growth by ensuring an undefeated flow of surplus funds for deficient units. Flow of funds for productive purpose is also possible. It leads to the overall economic growth. Entrepreneurship growth. Financial markets contributes to the development of the entrepreneurial class by making available the necessary financial resources. Industrial development. The different components of the financial markets help an accelerated growth of industrial and economic development of a country, and thus contributing to raising the standard of living and society's well-being. Functions of financial market. Intermediary functions. The intermediary functions of a financial market include the following: transfers of resources, enhancing income, productive usage, capital formation and price determination, self-mechanism and information. Now we can see the explanations. Financial markets facilitates the transfer of real economic resources from the lenders to the ultimate resources, thus transfer of resources. Enhancing income. Financial markets allow lenders earn interest divided on their surplus investable funds, and thus contributing the enhancement of the individual and the national economic growth. Productive usage. Financial markets allow for the productive use of funds borrowed and thus enhancing the income and the cross-national production. Capital formation. Financial markets provides a channel through which new savings flow to aid the capital formation of a country. Financial determination or price determination. Financial markets allow for the determination of the price of a traded financial asset through the interaction of buyers and sellers. They provide a signal for allocation of funds in the economy based on the demand and the supply through the mechanism called price discovery process. Sale mechanism. Financial market provides a mechanism for selling and financial assets by investors. So, after they offer the benefits of the marketability and the liquidity of the such assets. Information. The activities of the participants in the financial market results in the generation and the consequent dissemination of the information to the various segments of the markets, so as to reduce the cost of transaction of financial assets. Now we can see our second functions of financial market, financial functions. The financial functions of the financial markets include the following: providing the borrower with funds as to enable them to carry out their investment plans, providing the lenders with the earning assets so as to enable them to earn the wealth by deploying the assets in the productive ventures, providing liquidity in the market so as to facilitate trading of funds. Now we can see about new issue market, NIM, versus secondary market. Since private properties are held liable for satisfying the business debits, he can get more financial assistance from others. Classification of financial assets. Financial assets can be classified differently under different circumstances. One such classification is marketable assets, non-marketable assets. Marketable assets. Marketable assets are those can be easily transferred from one person to another without much hindrance. Example: shares of listed companies, government securities, bonds of public sector undertaking, etc. Non-marketable assets. On the other hand, if the assets cannot be transferred easily, they come under this category of market. Example: bank deposits, provident funds, pension funds, national savings certificate, insurance policies, etc. The classification is shown. Now we can see about capital market. The term capital market refers to the facility and institutional arrangement through which the long-term funds, both debt and equity, raised and invested. It consists of a series of a channel through which savings of a community are made available for industrial and commercial enterprises and for the public in general. It directs these savings into their most productive use in leading to the growth and development of the economy. The capital market consists of the development banks, commercial banks and stock exchanges. An ideal capital market is one where finance is available to responsible cost. The process of economic development is facilitated by the existence of a well-functioning capital market. Meaning and definition: capital market is a market where buyers and sellers engage in the trade of financial securities like bonds and stocks. The buying and selling is undertaken by the participants such as the individuals and institutions. Capital markets forms an importance of a core of country's financial system. Capital market can be defined as a market for borrowing and lending of a long-term capital funds required by the business enterprises. Capital market offers an ideal source of external finance. It refers to all facilities and institutional arrangements for borrowing and lending market, medium-term and long-term funds. Like any market, the capital market is composed of those who demand funds, borrowers, and those who supply funds, lenders. According to Arun K. Tata, capital market may define as the complex of the institution investments and practices with the established link between the demand for and supply of different types of capital gains. Now we can see about characteristics of capital market. Following are the nature characteristics of a capital market. Securities market, price, location, participants, market for financial assets are the characteristics of a capital market. Securities market. The dealing in the capital market are done through the securities like shares, debentures, etc. The capital market is thus called the securities market. Price. The price of the security is determined based on the demand, supply prevailing in the capital market for securities. Participants. There are many players in the capital market. The participants of a capital market include the individuals, corporate sectors, governments, banks, and other financial institutions. Location. Capital market is not confined to certain specific location, although it is true that parts of the markets are concentrated in certain well-known as centers known as stock exchanges. It has its impact in the overall economy where suppliers and users or capital get together and do the business. Market for financial assets. Capital markets provides a transaction platform for long-term financial assets.
Kinds of capital market.
The capital market is divided into the primary market and secondary market. Now we can see about primary market. Primary market is a market for new issues or the financial claims. Hence it is called new issue market. The primary market deals with those securities which are issued to the public for the first time. In the primary market, borrowers exchange new financial securities for long-term funds. Thus, primary market facilitates the capital formation. There are three ways by which a company may raise capital in the primary market. They are public issue, the most common method of the raising capital by new companies, thus through the sales of securities to the public. It is called public issue. Rights issue. When an existing company wants to raise additional capital, securities are the first offered to the existing shareholders on the preemptive basis. It is called rights issue. Private placement. Private placement is a way of selling securities privately to the small group of investors. Secondary market. Secondary market may be defined as the market for all securities in the sense that securities which are previously issued in the primary market are traded here. The trading place takes between the investors who follows the original issue in the primary market. It covers both stock exchange and over-the-counter market. Functions and importance of capital market. Capital market has a crucial significance to the capital formation. For speedy economic development, the capital formation is the necessary. The significance of a capital market in the economic development is explained below. Savings and capital market or formation. In the capital market, various types of securities helps to mobilize savings from the various sectors of production, individuals, corporates, government, etc. The twin features of a responsible Return and liquidity to the stock exchange are defined incentive to the people to invest in the securities that accelerates the capital formation in the country. Permanent capital. The existence of a capital market stock exchange enables the companies to raise the permanent capital. The investors cannot commit their funds for a permanent period, but companies require the funds permanently. The stock exchange resolves with the dash of interest by interesting on the opportunity to the investors to buy or sell and their securities, while permanent capital with the company remains unaffected. Industrial growth. The stock exchange is a central market through which resources are transferred to the industrial sector of the economy. The existence of such institutions encourages people to invest in the productive channels. Thus, it stimulates the industrial growth and economic development of the country by mobilizing funds for investments in the incorporated securities. Ready and continuous market. The stock exchange provides a central, convenient place where buyers and sellers can easily purchase and sell the securities. Easy marketability makes the investment in securities more liquid as compared to the other assets. Reliable guide to performance. The capital market serves a reliable guide to the performance and financial position of the corporate and thereby promotes the efficiency. Proper channelization of funds. The prevailing market of the price security and the relative yield are guiding factors for the people to channelize their funds in a particular company. This ensures the effective utilization of the funds in the public interest. Provision of variety of services. The financial institution functioning in the capital market provide a variety of the services such as a grant of long-term and the medium-term of loans to the entrepreneurs, provisions of underwriting facilities, assistance in the promotion of companies, participation in the equity capital, giving expert advice, etc. Development of the backward areas. Capital markets provides a fund for the projects in backward areas. This facilitates the economic development of the backward areas. Long-term funds are also provided for the development projects in backward and rural areas. Foreign capital. Capital markets makes it possible to generate the foreign capital. Indian firms are able to generate the capital from funds from the overseas market by the way our bonds and the securities are. Government has liberalized foreign direct investment FDI in the country. This not only brings in the foreign capital but also foreign technology, which is important for the economic development of the country. Easy liquidity. With the help of secondary market, investors can sell off their holdings and banks also allow the investors to convert them into a liquid cash and their deposits when they are in need of funds.
Indian capital market
Evolution and growth. The period between 1947 and 1973 marked the development of infrastructure for the capital market. During this period, a network of development financial institutions such as IFCI, ICICI, IDBI and UTI, SFCS and SIDCS were established. These financial institutions strengthened the capital market. During the period between 1980 and 1992, debentures emerged as a powerful instrument of resources mobilization in the primary market. The public sector bonds were introduced. A number of stock exchanges came into the existence. There was a spontaneous growth in the secondary market. SEBI emerged as an effective regulatory body for the primary and secondary markets and offered a measure of protection to small investors. A new financial services such as a credit rating was introduced. A number of committees were constituted in the order to suggest the measures to revamp and restructure the working of the secondary market and cause buoyancy in the primary market. Some of these committees were Committee on Organization and Management of Stock Exchange, Working Group on the Development of a Capital Market, a study group for guidelines relating to the valuation and new instruments, a high-powered study group of establishment of new stock exchange, a committee of trading in public sector bonds and the units of mutual funds. Now we can see about new financial institutions. A number of institutions of finance have been established to cater to the credit requirements of the various segments of the industries and needs. A brief outline of these institutions is presented below. Venture Fund Institution. Venture capital financing is a form of equity financing designed especially for the funding new and innovative project ideas. Venture capital funds bring into the force the high technology projects which are converted into the commercial products. Many specialized financial institutions have promoted their own venture and capital funds. They include the Risk Capital Foundation of IFCI, Venture Fund of IDBI, SIDBI, Technology Development and the Infrastructure Corporation of India, and others. Mutual funds, financial institutions that provide the facilities for channeling the saving of small investors into the avenues of productive investments are called mutual funds. A mutual fund company invests the funds pulled from shareholders and gives them the benefit of the diversified investment portfolio and the responsible return. Specialized financial institutions like LIC, UTI, etc. Beside the commercial banks such as SBI and Canara Bank are carrying out the business of mutual funds. The benefits of mutual fund are high return, easy liquidity, safety and tax benefits to the investors. Factoring institution. Factoring is the arrangement whereby a financial institution provides the financial accommodation on the basis
of assignments, sale of
account receivables. The factoring institution collects the book debits for an institution operating for India are SBI, Factors and Commercial Services Private Limited, a subsidiary of State Bank of India, and Can Bank Factors Limited, a subsidiary of a Canara Bank. Over the Counter Exchange of India, OTCEI. The OTCEI was set up by the premier financial institution to allow the trading of securities across the electronic counters throughout the country. It addresses some specific problems of both investors and medium-sized companies. Some of the greater strengths of the OTCEI are transparency of transactions, quick deals, faster settlements, and better liquidity. National Stock Exchange of India Limited NSEI. NSEI was established in 1992 to function as a model stock exchange. The exchange aims at providing the advantage of nationwide electronic screen-based the scrumples and flawless trading system in the securities. The institution is expected to allow for the efficient and transparent system of the securities trading. National Clearance and Depository System NCDS. Under the scriptless trading system, settlement of transaction relating to the securities takes place through the book entry. The entry scriptless trading system comprises the following three segments: National Trade Comparison and Reporting System, which prescribes the terms and conditions of a contract for the securities market. National Clearing System, which aims at determining the net cash and the stock liability of each broker on the settlement date. National Depository System, which arranges to provide for transfer of the ownership of securities in exchange of the ownership of securities in the payment by book entry on the electronic ledgers without any physical movement of the transfer deed. National Securities Depositories Limited. The NSDL was set up by in the year 1996 for achieving a time-bound dematerialization as well rematerializations of the shares. The establishment of NSDL is expected to alleviate the problems of post-trade transactions in the secondary market. Stockholding Corporation of India Limited SHCIL. Stockholding Corporation of India Limited SHCIL aims at serving as essential securities of the depository in respect of transaction on the stock exchanges. The corporation also takes up an administration of the clearing function at a national level.
Foreign exchange market.
The foreign exchange market upsets the foreign exchange trading. It is the largest, most liquid market in the world with an average trade value for more than 5 trillion per day. It includes of all the currencies in the world, and any individual company or a country can participate in it. Commodity market. A commodity market manages the trading in the primary products which takes place in the above 15 major commodity markets where the financial transaction increasingly outstrip the physically purchases, which are to be delivered commodities are commonly classified into the two subgroups: hot commodities market, soft commodities market. Hot commodities market are raw materials typically mined such as gold, oil, rubber, iron and the ore. Soft commodities are the typically grown agriculture primary products such as wheat, cotton, coffee and sugar. Derivatives of a market. Derivatives of the market facilitates the trading in the financial market such as future contracts on the option used to help the control financial risk. The instrument desire the value mostly from the value of an underlying assets that can come in many forms: bonds, stocks, commodities, currencies and mortgages. Now we can see the money market. Money market is a market for purely short-term funds. It leads with the financial assets and the securities whose maturity period does not exceed 1 year. Meaning and definition: money market is a segment of the Financial markets wherein the financial instruments having the maturities to less than the 1 year are traded. Examples: treasury bills, commercial bills, certificate of the deposits, government securities, etc. According to the Crowther, the money market is a collective name given to the various firms and institutions that deal in the various grades of near money. The RBI defines the money market as a market for short-term financial assets that are close substitutes of money facilities that are close substituents of exchange of money for new financial claims. In the primary market, as also for financial claims already issued in the secondary market. Objectives and characteristics. Objectives: a well-developed money market serves the following objectives: providing an equilibrium mechanism for ironing out short-term surplus and deficits, providing a focal point for central bank intervention of the influencing liquidity in the company, providing access in the use for uses of short-term money to meet their requirements at a responsible price. Characteristics: short-term funds. It's a market purely for the short-term funds of the financial assets called the near money. Maturity period: it deals with the financial assets having a maturity period up to 1 year only. Conversion of cash: it deals with only the assets which can be converted into the cash readily without loss, and the minimum transaction is cost. No formal place: generally transaction takes place through the phone, oral communication, relevant documents and written communication can be exchanged subsequently. There is no formal place like the stock exchange as in the case of capital market. Submarkets: it is not a single homogeneous market. It comprises of several submarkets, each specializing in a particular type of financing. Example: call money market, acceptance market, bill market. Role of market: the components of a money market are the central bank, commercial bank, non-houses and the acceptance house. Commercial banks generally play a dominant role in the market. Highly organized banking system: the commercial banks are the nerve center of the whole money market. They are the principal suppliers of the short-term funds. The commercial bank serves as a vital link between the central bank and the various segments of the money market. Existence of a secondary market: there should be an active secondary market for these instruments. Demand and supply of funds: there should be a large demand and supply of short-term funds. It presupposes the existence of a large domestic and foreign trade. Wholesale market: it is a wholesale market and the volume of funds of the financial assets traded in the market is very large. Flexibility: due to the greater flexibility in the regulatory framework, there are constant endeavors for introducing the new instruments. Presence of a central bank: the central bank keeps their cash reserves and provides them the financial accommodation in the difficulties by discounting the eligible securities. Through its open market operations, the central bank absorbs the surplus cash during the off seasons and provides additional liquidity in the business season. Participants of money market: there are many participants operating in the money market. The participants dealing with the money market instruments like treasury bills, commercial papers, etc. Government of different countries, central banks of different countries, private and public banks, mutual funds institutions, insurance companies, non-banking financial institutions, RBI and SBI, commercial banks, state governments, public. Money market instruments. There are many kind of instruments available in the money market. In India, till 1986, only a few instruments were available. They were as follows: treasury bills in the treasury market, money at call and short notice in the call loan market, commercial bills and the promissory notes in the bill market. Now, in addition to the above, the following new instruments come into the existence: commercial papers, certificate of deposits, interbank participants of the certificates, repo instruments. These instruments are briefly highlighted in this chapter. Treasury bill market. A market for the purchase and the sale of treasury bills is known as the treasury bills market. Treasury bills. Treasury bills are very popular and enjoy a higher degree of the liquidity since they are issued by the government. A treasury bill is nothing but a promissory note issued for the specific period stated therein. The government promises to pay the specified amount mentioned therein to the bearer of the instrument on the due date. The period does not exceed a period of 1 year. General features. Treasury bills incorporate the following general features: issuer, financial bills, liquidity, vital source, and monetary management. Types of treasury bills. Treasury bills are issued to the public and other financial institutions for meeting the short-term financial requirements of the central government. These bills are freely marketable and they can be bought and sold at any time, and these bills are tradable in the secondary market as well. On the basis of periodicity, treasury bills may be classified into three. They are 91 days treasury bills, 182 treasury bills, and 364 days treasury bills. 91 days treasury bills are issued at a fixed discount rate of 4% as well as through auctions. The RBI holds 91 days and 182 days treasury bills, and they issued on the top basis throughout the week. 364 days treasury bills do not carry any fixed rate. The discount rate of these bills are quoted in the auction by the participants and accepted by the authorities. Such a rate is called cut-off rate. Certificates of deposits. Specimen copy of certificate of deposit. Certificate of deposits are short-term deposit instruments issued by banks and financial institutions to raise the large number sums of the money. Certificate of deposits are issued in the form of usance promissory notes. They are easily convertible in nature and are marketable for having a particular face value and maturity. The certificate of a deposit is transferable from one party to another. Due to their noticeable feature, they are also known as negotiable certificate of deposit. Issuers. The issuers of the certificate of deposits are commercial bank, financial institutions, etc. Subscribers. Certificates of deposits are available for the subscription by the individuals, corporation, trusts, associations and NRIs. It is a document of a title to the time deposit. It is a barrier certificate and the negotiable in the market. Features of certificate of deposits. Document of title in the time deposit. It is an unsecuredable negotiable instruments. It is freely transferable by endorsement and delivery. It is issued at the discount for the face value. It is repayable on the fixed date without the grace days. Commercial bills. A bill of exchange issued by the commercial organization to raise the money for short-term needs. These bills are of 30 days, 60 days and 90 days of maturity. The commercial bill is an instrument drawn by the seller of the goods and buyers of goods. It possesses the advantage like self-liquidating in the nature, resources of two parties, knowing the exact date of the transaction, transparency of transactions, etc. Specimen copy of commercial bill. Features. The features of the commercial bills are as follows. Drawer, acceptor, payee, discounter, endorser, assessment, maturity, credit rating. Types. Demand bills. A demand bill is one wherein no specific time of payment is mentioned. So, demand bills are payable immediately when they are presented to the drawee. Clean bills and documentary bills. Bills that are accompanied by the documents of the title of goods are called documentary bills. Clean bills are drawn without the companies of any document. Example, railway receipt and lorry receipt. Inland bills and foreign bills. Bills that are drawn and payable in India on a person who is resident in India are called inland bills. Bills that are drawn outside the India and are payable either in India or outside India are called foreign bills. Indigenous bills. The drawing and acceptance of the individual bills are governed by the native, custom or usage of trade. Accommodation bills. Accommodation bills are those which do not arise out of genuine trade of transactions. Government or gilt-edged securities market. A market whereby the government or the gilt-edged securities can be bought and sold to the called the government securities market. Government or gilt-edged securities. Government securities are issued for the purpose of refunding the maturing securities, for advance refunding securities which have not yet matured, and cash financing, raising fresh cash resources. Characteristics. Government securities plays a significant role in Indian money market. The characteristics of a government securities are discussed below. Agencies. Government securities are issued by the agencies such as the central bank, state governments, semi-government authorities like local government authorities, example municipalities, autonomous institutions such as metropolitan authorities, post trust, etc. RBI special role. RBI takes place a special and an active role in the purchase and sale of these securities as part of the monetary management exercises. Nature of securities. Securities offer a safe avenue of the investments through the guaranteed payment of interest and repayment of financial by the government. Liquidity profile. The liquidity profile of the gilt-edged securities varies. Accordingly, liquidity profile of the securities issued by the central government is high. Tax rebate. A striking feature of these securities is that they offer a wide range of tax incentives to the investors. This has made these securities have popular for this benefit. Market. As each sale and the purchase has to negotiated separately, the gilt-edged market is an over-the-counter market. The government securities market in India has two segments, namely primary market and secondary market forms. The securities of the central and the state government takes place such as the inscribed stock or the stock certificate, promissory note or the bearer bond. Participants. The participants' government securities markets include the government sector comprising the central and state governments, whose holding the represent governmental transfer of the resources. Trading. Also, the secondary market for the government securities in the narrow, small and less active banks and corporate holders who purchase and sells the government securities on the stock exchange participate in trading. Issue mechanism. The Public Debt Office PDO of the RBI undertakes to the issue government securities. Issue opening. A notification for issue of the securities is made by few days before the public subscription is opened. Grooming gradual. Acquisition of the securities nearing the maturity through the stock exchanges by the RBI in order to facilitate redemption is described as grooming. Switching. The purchase of one security against the sale of another security out by the RBI in the secondary market as a part of its open market operation is described as switching. Auctioning. A method is of trading whereby the bid against the securities are sold to the highest bidder is known as auctioning.
Stock exchange.
Stock exchange contributes in a huge measure to the growth and expansion of a national business and to the ultimate benefit and well-being of the national economy and its people. They provide an ideal contact with through which the enormous amount of capital flows through the interconnected network of the financial organizations to all the corporate enterprises in the country. Thus, stock exchanges ensures the liquidity and transferability of the financial assets they are deal with. Stock exchanges organized market provided a place for the investors to buy the sellers and the security freely. The market offers the perfectly competitive conditions where a large number of buyers and sellers participate. Further, stock exchange provides an auction market in which members of the exchange participate to ensure continuity of price liquidity to investors. The efficient functioning of the stock exchange is responsible for creating an conducive climate for an active and growing primary market for new issues. Moreover, an active and healthy secondary market in the existing securities leads to the better psychology of expectations, considerably broadening the investment inquiries and thereby rendering the task of raising resources by entrepreneurs easier. Good performance and outlook for equities and the stock exchanges imparts buoyancy to the new issue market. Stock exchange origin, meaning, definition. Amsterdam, the stock exchange is considered as the old stock exchange in the world. It was established in the year 1602 by the Dutch East India Company called Verenigd Oost-Indische Compagnie called VOC. It was later registered as the Amsterdam Bourse. The first stock exchange in India was the Native Shares and the Stock Brokers Association. It was recognized by the Government of India on August 31, 1957. Under Securities Contract Regulations Act 1956, it became the Bombay Stock Exchange subsequently, meaning stock exchange, also called the stock market or the share market, is one of the important constituencies of the capital market. Stock exchange constituent of the capital market is an organized market for the purchase and the sale of industrial and financial security. It is a convenient place where the trading is security is conducted in the systematic manner as per certain rules and regulations. It performs various functions and offers the useful services to investors and borrowing companies. It is an investment intermediary and facilitates the economic and industrial development of the country. Stock exchange is an organized market for buying and selling corporate and the other securities. Here, securities are purchased and sold out per certain well-defined rules and regulations. It provides a convenient and secure mechanism or platform for transaction in different securities. Such securities include the shares and debentures issued by the public companies which are duly listed at the stock exchange, and bonds and debentures issued by the government, public corporation and municipal and port trust bodies. Stock exchanges are indispensable for the smooth and orderly functioning of a corporate sector and the free market economy. A stock exchange needs to be treated as a place for speculation of gambling den. It should act as a place for safe and profitable investment. For this, effective control on working of a stock exchange is necessary. This will avoid the misuse of the power this platform for the excessive speculation, scams and other undesirable and anti-social activities. London Stock Exchange (LSE) is the most popular stock exchange in the world, while Bombay Stock Exchange (BSE) is the oldest stock exchange in India. Similar stock exchanges exist and operate in the other parts of the world. Tokyo Stock Exchange, Bangkok Stock Exchange, Singapore Stock Exchange, Dubai Stock Exchange, New York Stock Exchange. Definition: according to Hastings, stock exchange or the security market comprises all the places where buyers and sellers of stocks and bonds or the representatives undertake the transaction involving the sale of securities. According to Husband and Dockery, stock exchanges are privately organized markets which are used to facilitate the trading in securities. The Indian Securities Contracts Regulation Act of 1956 defines stock exchange as an association, organization or body of individuals, whether incorporated or body of individuals, not established for the purpose of assisting, regulating and controlling business in buying, selling and dealing in the securities.